So you missed a required minimum distribution. It happens. But what happens next can trigger a pretty massive penalty from the IRS. The good news? There is absolutely a way out. In this deep dive, we are going to walk through, step by step, exactly how to request a waiver. We're covering it all, from the legal arguments you need to build, right down to the precise words you have to write on your tax forms.
All right, we've structured this into 5 key sections. First up, we'll tackle the penalty itself, what you're actually up against. Then, we'll get into the real heart of the matter, proving you had a reasonable cause for the shortfall. After that, we'll cover the corrective actions you have to take, how to get the critical paperwork filed perfectly, and finally, we'll touch on some new rules and relief from the IRS that could change your whole strategy.
Okay, let's start with the stakes. And believe me, they are high. Missing an RMD isn't like forgetting to pay a utility bill. The IRS sees this as a major issue, and the penalty they've designed, well, it definitely reflects that.
The number you absolutely need to burn into your brain is 25%. That is the penalty on whatever amount you failed to withdraw. Let that sink in. If your RMD was, say, $50,000, missing it could cost you an extra $12,500. Just gone. As a penalty.
And it's really important to get this next part. The IRS doesn't just call this a late fee. No, they classify it as an excise tax. That's a formal tax that you, the individual, are on the hook for. It's their way of signaling just how seriously they take this stuff. And it's why you can't just cross your fingers and hope it goes away.
Now, there is a silver lining here. It used to be much, much worse. Before the Secure 2.0 Act, this penalty was a staggering 50%. Can you imagine? So yes, they've cut it in half, which is great, but let's be real. A 25% hit is still a massive blow, and that's exactly why getting a waiver is almost always goal number 1.
So how in the world do you get this penalty waived? Well, the law provides a pathway, but you've got to earn it. The IRS basically has a 2-part test. And the first part, and honestly the most important, is proving you had a reasonable cause for making the mistake in the first place.
And this brings us to the absolute key phrase, pulled directly from the Internal Revenue Manual itself, Ordinary Business Care and Prudence. This is the benchmark. This is the standard they're going to judge your situation against. They're asking a simple question. Did you act like a responsible person would, given your circumstances? It's not about being perfect. It's about being prudent.
So what actually counts as reasonable? Well, the IRS gives us some pretty clear examples. And we're not talking about flimsy excuses here. We're talking about serious life events, things like a severe medical issue, a documented mistake by your bank or brokerage, or even getting bad advice from your own accountant. Any of these can be a valid foundation for your case.
But here's the kicker, right? You can't just say you were sick or that your bank messed up. You have to prove it. The burden of proof is 100% on you to provide solid, concrete evidence that will convince the IRS agent looking at your file. So what does that evidence look like?
Building a compelling case really boils down to 3 things. First, documentation. This is your hard proof. A letter from your doctor, hospital records, an email from your financial institution admitting fault. Second, a timeline. You need to map out a clear, logical story of what happened, when, and how it directly stopped you from taking that RMD. And third, you have to show that this was an isolated incident, that you handled your other financial affairs responsibly.
Okay, so proving you had a reasonable cause for the past mistake, that's part 1. But there's a second part to this test that's just as crucial. You have to demonstrate to the IRS that you are taking immediate, concrete steps to fix the problem now. A great excuse for what happened yesterday is totally useless if you don't take the right action today.
The remedy itself is pretty straightforward, but you have to be quick and precise. Step 1, calculate the exact amount you missed down to the penny. Step 2, and this is so important, withdraw that entire shortfall amount as soon as you discover the error. Don't wait. Any delay could weaken your argument. In Step 3, remember that withdrawal counts as taxable income in the current year, the year you take it, not the year you should have taken it.
Now here's a subtle but really valuable detail about that corrective withdrawal. You only need to take out the original RMD amount that you missed. You do not have to go back and figure out any earnings that money might have generated while it was sitting in the account. You're just making the original distribution whole. That's it.
All right, now we get to the most critical part of the execution. You've got your story, you've taken the corrective steps. Now you have to package all of this and communicate it to the IRS using the right form and the right procedure. Honestly, this is where so many waiver requests fall apart.
just simple paperwork errors.
The central piece of this puzzle is Form 5029, but you have to be so careful with how you fill this out. There's a very specific, almost code-like way to mark this form that signals to the IRS computers, hey, I'm aware of the shortfall, but I'm officially requesting a waiver, and I do not believe I owe this tax.
And here is the exact syntax. You have to get this perfect. On Form 5029, you go to line 54. In the actual box for the penalty amount, you write a big fat 0. Then, on the dotted line just to the left of that box, you write 2 letters, RC for reasonable cause, followed by the actual dollar amount of your shortfall in parentheses. That's the magic formula.
And along with that form, you absolutely must attach a letter of explanation. Think of this as your closing argument. It needs your name, your social security number, and a clear reference line. Then you lay out the factual narrative, detail the exact steps you took to correct it with dates and amounts, and you end with a formal sentence requesting the waiver. This letter is your case to the IRS.
Okay, finally. Let's talk about some very recent developments thanks to the Secure 2.0 Act and some other IRS notices. These have really changed the strategic landscape for dealing with a missed RMD, and they give you some powerful new options to consider.
Secure 2.0 created a whole new path. On top of dropping the main penalty to 25%, it also introduced a reduced 10% penalty. So now you have a choice. You can go the traditional route, file for the waiver, and shoot for a 0% tax, but it's at the IRS's discretion. Or you can proactively pay a 10% tax and get immediate certainty. The case is closed.
And you also need to be aware of this special relief. The original Secure Act caused a ton of confusion around the new 10-year rule for beneficiaries. Because of that widespread confusion, the IRS has basically issued a get-out-of-jail-free card, an automatic waiver for certain missed beneficiary RMDs all the way from 2021 through 2024. If this is your situation, you might not even have to file the form. And all this leaves us with a really interesting strategic question to ponder. With this new 10% option on the table, is going for the full waiver always the best move? For smaller RMD shortfalls, or maybe the cost of hiring an accountant is a big factor, does the certainty of just paying 10% and being done with it now outweigh the effort, the cost, and the sheer uncertainty of a full waiver request? It's a whole new calculation everyone has to make.